But I am still of the mindset that it will get there, but maybe not as easily as we went from the 2000 level, which we finally broke through and hit, 3,500 pretty quickly. I think we're going to need to kind of work this base and then go higher. $500 more is a nice move, but nothing like the $1,500 that we saw from the 2000 level. Eventually, I think we're going to see even higher than 4,000. But from my perspective right now, I think we're still going toward a system that's being pushed or propagandized, if that's a word, into a system of more control, not less. And the more freedom the people have with their money, the more freedom we have overall. And the more control the bankers have of the money, the more control they have overall.
Over the past several months, the precious metals market has experienced a notable surge in both investor interest and price action. Gold climbed toward the $3,500 mark, while silver advanced close to $39, marking one of the strongest phases of inflows into the sector in recent years. These gains came amid a backdrop of elevated inflation concerns, uncertain monetary policy, and geopolitical instability, which together drove capital toward historically reliable stores of value. Although both metals have recently pulled back slightly, the broader structure of the market points to a consolidation phase rather than a reversal. This pattern reflects a healthy digestion of recent gains and signals that capital remains positioned in the sector, awaiting the next phase of movement. David Morgan has emphasized the importance of this consolidation as part of a larger structural trend. Earlier this year, Morgan accurately projected that gold would enter a trading range during the summer, with silver and platinum outperforming in the interim. That rotation has largely occurred, and now, like gold before them, silver and platinum are entering their base-building phases. Historically, August represents a seasonal low for gold, followed by renewed momentum in September as market participants re-engage after the summer lull. This cyclical behavior suggests that the recent flattening in prices is not indicative of weakness, but of stabilization, a process that builds stronger support levels and increases the likelihood of sustainable upside in the future. The broader macroeconomic narrative continues to favor precious metals over the long term. Despite the temporary pause in upward momentum, institutional forecasts projecting gold prices as high as $4,000 highlight continued belief in metals as a hedge against systemic risks. Morgan points out that value, rather than price alone, should remain the key focus for long-term investors. Gold and silver must be viewed not just in dollar terms, but in what they can purchase. In this light, ongoing capital inflows into physical assets and hard commodities reinforce the case for precious metals as tools of wealth preservation. As the financial system faces growing structural pressure, the positioning in gold and silver remains fundamentally sound, with the current consolidation likely to serve as a launchpad for the next leg of the secular bull market. Now, we present the clips from David Morgan's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
I would say you could call it a change of trend. I mean, from my perspective, and if you want to call it analysis, I think we have peaked temporarily. I mean, first of all, I said that at gold at 3,500 a couple months back, and I wrote, for our premium service that gold would be doing a trading range throughout the summer and possibly longer. And I also said that during that point in time, it would be good to either trade gold for platinum or silver, or if you wanted to add your positions, add platinum, add silver, and both those metals took off relative to gold. So in other words, gold stayed basically steady state, and both platinum and palladium recently have all shot up. However, I think they have hit that point that gold did a few months back, meaning that they are going to establish a range for a while. I think how long, I don't know yet. I haven't seen enough data, but I would just guess probably through the end of the summer. For example, we're end of July. August is usually the worst month or best month, depending on how you look at it, for gold. In other words, usually the cyclical low for gold is established in August. So that's another month out. And then September, the old adage, sell in May and come back after Labor Day. That's usually about the third week of September. So I would guess, from historic precedent, we would see probably all four metals move in a trading range from here, probably for a couple months at a minimum. Obviously, something could hit. But most of the news that's favorable to the metals is already kind of put into the price. And I know everyone's thinking there's very little resistance for silver from, 39 up. But hit 39 briefly, and now it's dropped off about $1, he said. So that's it. Sideways is what I expect. Doesn't mean the bull market's over. It's really healthy for markets to consolidate and build another base and move up. I made that comment on another interview recently. And what you really don't want is a higher price every day, and then you get into a parabolic move. Those are not sustainable. But if you staircase up, you build a base at 32, then it jumps up to 34, and you build a base there, and then it jumps up to 36, and you build a base there. Of course, that's an idealized base because, they go up and down. But basically speaking, if you look at the charts, that's kind of what it looks like, a stair. And those are pretty stable because you have a base, so then you have a support level. Then you move up and you build another support level. So that's what I'm looking at.
No, I know there's been some, in some sense, good news about the trade wars, some deals being made with Japan and the EU. Do you see that having any long-term impact on the price? I know the prices are off slightly because of that news, though, in the metals.
Well, as we both know, the tariff situation is like playing 21 at Las Vegas. You could keep rolling the dice over and over and coming up with a different number. But on the basis of what you asked me, yeah, I think there's a little more stability, a little more reconciling what these tariffs are really going to look like, and a little more solidity to the proposition that, here's what we're going to do. And you can kind of like depend on that. So, yeah, I think markets hate instability. They hate the unknown. So even though tariffs might not be suitable to the counterparty that has to pay them, once they are established and consistent and they know what they're going to be for some, time frame, then the market can kind of, take that in and work with it. Yeah, I think we're at again, that trading range. And that's what I call an indecision pattern. It's kind of equal bulls and equal bears. No one's really winning. The bears win and the market goes down $100. The bulls win and it goes up $100. I'm referring to gold. And that means that just what I said. So what's going to take it to 4,000? Well, the bulls have to win. There has to be more buying pressure than selling pressure. What would cause that? Well, there's a number of things. But most are out there already. The war situation, Middle East, Ukraine hasn't gone away, flare-ups in Pakistan that have cooled off. So all of those things that are really favorable to an increase in gold prices are already there and pretty well known. So what's going to take it to the next level? And that would probably be something in the financial sphere where we have, let's say another bond auction and no one shows up, as an example, where, yields are actually forced higher because demand is nothing. So to sweeten the deal, prices, their yield gets pushed higher. And that's just an idea. I'm not saying that's going to happen. I'm just giving you an example. But I am still of the mindset that it will get there, but maybe not as easily as we went from the 2000 level, which we finally broke through and hit 3,500 pretty quickly. I think we're going to need to kind of work this base and then go higher. $500 more is a nice move, but nothing like the $1,500 that we saw from the 2000 level. Eventually, I think we're going to see even higher than 4,000, but I'm writing a report right now, and depending on the overall global economic climate and what happens in the, I would say, non-reality, the stock market indexes. There's a gentleman that most of our viewers would probably be familiar with, Charles Nenner. And Nenner is very, very bold in his predictions, but he's also very accurate. And for an example, if we went from the high level of the Dow right now down to 5,000, for an example, thought experiment. David, it's never going to happen. I'm not that bold. I don't know the future. And gold made it to 5,000. Well, that would be a very interesting place to contemplate because many in our peer group talk about the gold to Dow ratio. And when the gold to Dow ratio hits 1, that's a pretty good sign that we've hit a top in the gold market, or conversely, a bottom in the stock market. I'm not saying that's going to happen. What I'm trying to convey, and I want to convey very strongly, is that the price of gold is what most everyone focuses on. But really, you want the value of gold. And this is something that Mike Maloney does very well. He talks about how much of a house do you get for an ounce of gold, how many barrels of oil, how many bushels of wheat, how much of the Dow Jones Industrial Average. And so if you thought about, let's say, a contraction in the economy and the housing prices came down nationwide, we just use the U.S. for an example, let's say 1/3, but gold went up by that $2,000 or $1,500 from $3,500 to $5,000. So you got that increase in gold, and you got a decrease in the housing market, or maybe the bond market, or the stock market, or the automobile market, which is suffering badly. So you have to look at it in terms of, what do I get for that? So it's not always a function of price. That's what we're taught to think, and we think prices all the time. But really, I think a better and more accurate measure is to look at what it buys in terms of other hard assets.
In recent months, inflation has surged to levels not seen in decades, causing widespread concern among consumers and investors alike. Housing prices continue to climb, and stock markets are reaching record highs, all reported in US dollar terms. However, financial experts like David Morgan caution that relying solely on the dollar as a measure of value can be misleading. The US dollar is a fiat currency, meaning no physical commodity, such as gold or silver, backs it. Instead, its value is derived from government regulation and confidence. As governments print more money to stimulate economies or cover debts, the purchasing power of the dollar diminishes due to inflation. This means that while prices for assets such as homes and stocks may appear to rise, the real value of these assets could be declining when measured against more stable benchmarks like precious metals. When housing prices and stock market valuations are expressed in gold or silver terms, a different reality emerges. Contrary to popular belief, housing is more affordable today than it has been in many years when priced against gold. Similarly, the impressive gains seen in the stock market often look less significant when adjusted for gold's performance, revealing how inflation and currency debasement distort our perception of wealth. Gold and silver have long served as safe havens during times of economic uncertainty because their supply is limited and their value is not subject to government manipulation. Incorporating these precious metals into investment portfolios offers a hedge against inflation and the hidden erosion of wealth caused by the declining value of fiat currencies.
Yeah, I agree. And I'll just add on to that. I mean, holding, precious metals, something I've advocated since before I began on the internet. But it's part of your portfolio. In other words, that's my specialty. That's what I advocate, and I'll give you the reasons why. But really, if we want to benefit, that paradox of, a win-win situation where your investments are helping you to have a better lifestyle, and at the same time, what you invested in is also helping society with a better lifestyle, or cleaner air, better water, better food, easier way of doing things, better communications, whatever it is. That's the paradox. You can, as a true capitalist, you can benefit yourself and society at large. And that's largely what I want to be on. I want to be on that where we're helping each other with, our, let's say, wise choices with what we invest in. However, when you get in a distorted situation like we've been in for many decades now, and really it happened before August 15th, 1971, when Nixon closed the gold window, because we were lying before then. And that's why he closed the gold window. We said the dollar is as good as gold, but it hadn't been for a long time. Basically got caught and said, I got to stop that contract, or I'm closing the gold window, as we refer to it. So the point is, we've got to come back to those basics. And you're right, there will be a time. Now, from my perspective right now, I think we're still going toward a system that's being pushed or propagandized, if that's a word, into a system of more control, not less. And the more freedom the people have with their money, the more freedom we have overall. And the more control the bankers have of the money, the more control they have overall. So I think we're at a nexus where there's a lot of people like you that have dedicated your life since I think age 16. I've done it most of my life to get the ideology out that, there is a direct correlation between free market economics and freedom versus some other system that really controls the system. And so we are at a very interesting point in history, but I'm just going to circle back and say you're correct. There will be a new one. And it's not necessarily the one that we have been taught about, and I've talked about, the CBDCs or a private version of the CBDC. I think that is the push. I think that's what they want. I've talked about it. I've been consistent about it. But I also hopefully have said it enough that just because that's what they want does not mean that's what's going to take place. Really inspired here the last couple of months. I mean, it was the 4th of July, and I was, I guess I was riding myself fairly hard, meaning that, what have I accomplished what I've wanted to achieve, which is to educate people enough for them to make up their own darn mind whether or not the system that we have is one that they would have chosen freely or not. And so I wrote that piece about, money and on the 4th of July, money and freedom, basically. And then I was inspired again to talk about, how much our faith, from my perspective, has been diminished over the last few decades. And where's the faith now? And the faith is it's not in God, it's in the other God. And what's that? Primarily, it's money. And so I just took off on that theme and thought, what does it really do? And so when you put your faith in, let's say, a false idol, then it revolves around value. And the propaganda is extremely good at this. I'm writing about it in the Morgan Report this month about the U.S. economy runs 70% on the consumer. That's kind of ridiculous, but that's our economy. And so we look for things outside of ourselves. So you've heard me say this before, Elijah, but always look for what you have, not what you have. And what I mean by that statement, I look for what you have as an individual as far as your integrity, your character, your moral values, your worldview, what you bring to the game rather than what you can get from it. That's your internal self. That's your relationship with whatever higher power you want to believe in or not, but it's your integrity, it's your authentic self. And what we're taught is what you have, which is everything external to you. What kind of car do you have, what kind of house, what kind of yacht, who are your friends, what's your selfie look like, what's your social media profile look like, what kind of meals do you have? I mean, people take pictures of their meals and put it on social media. I mean, if I'm free market, you're free to do that. And you are. To me, it's a little interesting, but this is the society we have. So we're looking outside of ourselves for that fulfillment, which you'll never get. You're going to get it from the heart outward. It's how big a heart do you have? I mean, some of the greatest stories ever told have to do with the underdog that has a big heart and is able to overcome all kinds of obstacles and move forward. So hopefully that's summarized it in a way that people can understand what my true meaning was in that piece, because I've seen it happen more and more as I've gotten older and older. And I'm just calling them as I see them. And you'll find as you get older, Elijah, I know you're still, quite young, at least relative to me, but you will, or I will speak for myself, you get a little more crotchety, which means you're a little more edgy and you're more prone to speak out a little harsher maybe than you were in the past, because, the political correctness is waning more and more, I'll say.
Gold has the potential to reach $4,000 an ounce by the end of next year, driven by a combination of factors including a weakening U.S. dollar, ongoing increases in central bank gold reserves, and a possible reduction in Federal Reserve interest rates aimed at supporting the economy. In a recent Bloomberg interview, a manager of a multi-asset fund at Fidelity International expressed continued confidence in the precious metals outlook. Despite gold's recent pullback from its record high above $3,500 an ounce in April, several cross-asset portfolios have taken the opportunity to increase their holdings, signaling strong institutional interest. The manager emphasized that the current gold bull market remains robust, noting that gold has annualized gains of about 20% per year from 2021 to the present, which aligns with the impressive 20% annualized growth seen during the well-known bull run from 2001 to 2011. This comparison suggests that gold's recent surge is not yet overextended and that the precious metal could have significant upside potential as global economic uncertainties persist, inflationary pressures continue, and investors seek safe haven assets in a shifting financial landscape. Share your thoughts on David's analysis of the silver price in the comment section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the next video. Thanks for watching.